Hello, everyone. Welcome to the Adkup Show. Imagine a number so big it's hard to wrap your head around. $324 trillion. That's a total debt the world is carrying right now, which is more than three times the size of the global economy. From the United States to Japan to developing nations like Nigeria and India, countries, businesses, and even households are borrowing at record level. But why is global debt skyrocketing? What's driving this massive pileup of IOUs, and what happens if we can't pay it back? Today, we are diving deep into the causes, consequences, and what this means for your future, whether you are paying taxes, saving for a house, or just trying to make sense of the world. So, without wasting time, let's get started. First, let's break down what we mean by global debt. It's the total amount of money owed by governments, businesses, and people like you and me. Governments borrow to fund things like roads, schools, or military spendings. Businesses take loans to expand or survive tough times. And when it comes to households, then we have got mortgage, credit card debt, or student loans. According to the Institute of International Finance, the global debt hit $315 trillion in 2024, which was up from $307 trillion in 2023. That's a jaw-dropping jump, and it's not just a number, it's a signal of how our world is changing. The global debt-to-GDP ratio, which measures debt against the size of economy, is now at 360%. That means for every dollar the world produces, we owe $3.60. So why does this matter? Well, high debt can choke your economic growth, raise taxes, or even spark crisis in your wallet. Think higher prices, fewer jobs, or unstable markets. And as we'll see, some countries are already on the brink. So let's unpack the 5 big reasons why global debt is skyrocketing. Alright, let's dive into the first reason. The COVID-19 pandemic. When the world shut down in 2020, the governments pumped trillions into their economies to keep things afloat. The United States, for example, passed a CARES Act, which was a $2.2 trillion stimulus package, followed by more spendings. By 2025, the US national debt is over $36 trillion, or 126% of its GDP, which is huge. Other countries did the same. Think furlough schemes in UK or subsidies in India. The IMF says global public debt jumped 10 percent points from 2019 to 2024, hitting 93% of the GDP last year. And here's the kicker. Even after the pandemic, many governments kept spending to recover, adding to the debt pile. Now let's talk about the interest rates. For years, central banks like the Federal Reserve and the Bank of Japan kept rates near zero. Borrowing was dirt cheap, so everyone from governments to companies to even you took out loans. Japan, with a debt-to-GDP ratio of 250%, which is the highest in the world, could afford it because low rates kept interest payments manageable. But when inflation spiked in 2022, central banks hiked rates. The Fed's rate is now around 4 to 5%, making new debt costlier and old debt harder to refinance. That's squeezing budget everywhere. Reason number 3, geopolitical and economic crisis. Wars and disruptions don't come cheap. Take the Russia-Ukraine conflict. Energy prices soared, forcing countries like Germany to borrow for subsidies to keep homes heated. Developing nations got hit even harder. Sri Lanka defaulted on its debt in 2022 after food and fuel costs skyrocketed. The World Bank says low and middle income countries paid $443 billion in 2023 just to service their debts. That's the money not going to schools or hospitals, but it's going to creditors. Next up, emerging markets face a unique trap. Many borrow in US dollars, but when their currency weakens, repaying that debt becomes a nightmare. Nigeria, for example, has seen its naira lose value, making dollar-denominated loans crippling. The IMF notes that 52% of low-income countries are in or at risk of debt distress in 2024. That's 59 countries, up from just 22 in 2011. These nations borrow more to cover old debts, creating a vicious cycle. Finally, it's not just governments. Corporations and households are borrowing like never before. In the US, household debt hit $17 trillion in 2024, fueled by skyrocketing home prices and student loans. Companies, especially in China, are drowning in debt. China's corporate debt is 28% of the global total. Think of companies like Evergrande, the Chinese real estate giant that collapsed under $300 billion in debt. When businesses borrow to survive rather than grow, it's a red flag for the economy. So what happens when debt gets this high? Let's break down the consequences, and trust me, they are not pretty. First, higher interest rates are making debt a lot costlier. The US, for instance, is projected to spend $952 billion on interest payment alone in 2025. That's almost $1 trillion that could have gone to school, healthcare, or infrastructure. It's like paying rent on money you already spent. For governments, this means tough choices. Raise taxes, cut services, or borrow even more. Second, emerging markets are in serious trouble. The IMF says 15% of low-income countries are already in debt distress, and 45% are at high risk. When countries like Zambia or Sri Lanka can't pay their debts, they face defaults. That sparks economic chaos. Think skyrocketing prices, job losses, even protests. In 2022, Sri Lanka's default led to riots and government collapse. And when countries turn to the IMF for bailouts, they often get strict conditions like cutting subsidies, which can hit the poorest the hardest. Third, there's a risk of global financial instability. High corporate debt, like China's real estate mess, could trigger something similar. If a big player like Evergrande defaults, it could ripple through global markets, crashing stocks and freezing credit. The IMF warns that in the worst-case scenario, the global public debt could hit 117% of GDP by 2027. That's higher than during the World War II. And here's the kicker. High debt fuels inequality and stagnation. When governments prioritize debt payments over investments like education or infrastructure, economies grow slower. Japan's been stuck in this trap for decades, with its lost decades of sluggish growth. Developing nations face an even bleaker future. Less money for schools or hospitals mean their people stay trapped in poverty. The World Bank estimates 100 countries will cut social spendings to meet debt payments. That's not just numbers, it's real people losing access to healthcare or education. Okay, so debt is out of control, but what's next? Let's look at the future. In the short term, rising interest rates could push more countries over the edge. The IMF predicts global public debt will hit 100% of GDP by 2030, surpassing the COVID peak. For emerging markets, this is a ticking time bomb. Countries like Ethiopia or Pakistan could face defaults if global financing tightens. And with geopolitical tensions like trade wars or conflicts adding pressure, governments might borrow even more for defense or subsidies. The IMF says a spike in geoeconomic uncertainty could add 4.5% to public debt by 2030. Long-term picture is mixed. Aging populations in places like Japan and Europe will drive up costs for pension and healthcare, piling on more debt. The OECD warns that slow economic growth and high debt could trap us in a cycle of borrowing just to stay afloat. But here's the hope. Some solutions could turn this around. First, debt restructuring. Think of Zambia, which got relief through IMF and World Bank in 2023. This can lower payments and give countries breathing room. Second, fiscal discipline. Government could cut wasteful spending to raise taxes smartly, like taxing wealth on carbon emission. But let's be real, that's politically very tough. Third, boosting economic growth is key. If countries like India invest in tech or infrastructure, they can grow their way out of debt, like the US did after World War II. The catch is it needs smart policies and global cooperation. Geopolitically, debt is shifting power. China, a major creditor through its Belt and Road Initiative, could gain leverage over struggling nations. Think Sri Lanka, where China took control of a port after a debt default. This debt trap diplomacy could reshape global alliances. Meanwhile, the US and Europe face their own challenges. Political gridlock makes cutting deficits hard, especially during elections. In the US, both parties' plans could add trillions to the debt, according to the Committee of Responsible Federal Budget. Now let's zoom out for a history lesson, because this isn't just a first debt wave. Back in 1970s, oil crisis pushed developing nations to borrow heavily, leading to defaults in 1980s. The IMF and World Bank stepped in with bailouts, but it came with strings attached, harsh reforms that sparked protests. Fast forward to the 2008 financial crisis, global debt soared as governments bailed out banks. The difference now is that the scale is bigger and the creditor landscape is messier. Private lenders like bondholders now hold 62% of developing countries' external debt, making restructuring trickier. However, history shows debt can be managed. Look at Germany's 1953 debt relief, which capped payments to fuel recovery. But today's world is more complex with new players like China and volatile markets. Ignoring debt risks repeats past mistakes, but smart reforms can pave the way for growth. So why is global debt skyrocketing? It's a perfect storm. Pandemic spending, low then high interest rates, geopolitical crisis, emerging market traps, and borrowing by companies and households. The consequences for this high debt are higher taxes, cut to services, potential crisis, and growing inequality. Looking ahead, we face tough choices: restructure debt, cut deficit, or even bet on growth. But history tells us we have been here before, and with the right moves, we can avoid disaster. However, it looks like disaster will happen this time, and after then only, things will change. So what's your take? Is global debt a crisis waiting to happen, or can we grow our way out of it? Drop your thoughts in the comments, and let's keep the conversation going. If you found this deep dive insightful, then smash that like button, subscribe, and hit the bell for more on economics, geopolitics, and history. I'll see you in the next video. Peace out.